Sharing the screen. Okay, so a lot of the auditing standard boards, they make auditing standards for, I should say, this more complete. Oops. And now remember, this is part of the AICPA, so this is just a club. But a lot of the auditing standard board's rules become laws in the states. The states take a look at those rules and say, hey, that would be a good law. And so a lot of times, even though they are rules made up by the ASB, Audit Standards Board, they're also state laws. So it's a good idea to follow them anyways. Okay, CPA exam, I think I talked about this already. The AICPA makes a CPA exam. They make the CPA exam that all of the states use to license the CPAs. Now, there is something here that is between these two that kind of creeps into the CPA exam. Obviously, if the AICPA is making the CPA exam, a lot of times they do concentrate on their own standards. So, because those are the standards that they set out, those are standards. But there are other standards in the world, but they focus mostly on the CPA exam, the AICPA standards. So if you're taking the CPA exam and you're not sure whose standards they're using, it's not a bad idea to assume, if you're not given any other information, that it's the AICPA standards. Sometimes they're not specific about it. State boards of accountancy. These are the people that license CPAs. Oops. And it's just like a driver's license. You pass a test, you get you pass a written test, then you get some experience, and then they give you a license. Same thing. Okay, issuers. Securities and Exchange Commission. Often it's called the SEC. All right, so issuers, again, these are people that issue financial statements to the public. The SEC regulates all publicly traded companies in the US. The SEC requires companies to use I'm gonna wait, let me change this. What I'm putting on here is technically not true, so I want to fix it. Okay, so they require the companies that are publicly traded to, let me make this in, let me do something here. I like the formatting I'm doing here. They require the companies to use the AICPA accounting standards. They require CPA firms auditing publicly traded companies to use so publicly traded companies. The SEC regulates all publicly traded companies. They require the companies use the AICPA accounting standards. So when they do their financial statements, they have to use GAAP, generally accepted accounting principles. And they require companies to use the auditing standards. So if you're an audit firm, you must use their auditing standards also. And this is called GAS, generally accepted auditing standards. I don't know why I put so many lines here and they're non-issuers. The SEC has no control over non-issuers. The SEC has no control over privately held corporations. So non-issuers do not have to follow SEC rules. So if they're publicly traded, they are under their regulation, and it's a pretty heavy regulation. But if they're non-issuers, so IBM has to follow the SEC rules. SEC says do this, they have to do it. Joe's hot dog stand, it's a corporation, but it's not publicly traded. SEC can't do anything. Joe can do whatever he wants. Well, I guess he can't do whatever he wants, but he doesn't have to worry about SEC regulations because it's a federal government agency, and it's only for publicly traded companies. I should probably put that in here too somewhere. This is a federal agency, doesn't have anything to do with the states. Here's a government agency. Oops. You probably noticed that's not how you spell government. That's not it either. We need an N in there. Okay. Okay, Public Company Accounting Oversight Board. Also known as the PCAOB. What am I doing here? Okay, the PCAOB. They just made this. They could have made it a better acronym or whatever. But anyway, the PCAOB was created by the Sarbanes-Oxley Act. You'll see this often is called SOX. The PCAOB regulates what they call reporting. I'm gonna start using the accounting speak of issuers. And their CPA firm. So the issuers be like, for instance, IBM, and the issuers, whoever audits them. It is part of the SEC. It is under the SEC. The PCAOB makes their own auditing standards. And one last note. PCAOB registers CPA firms to audit issuers. Capitalize that just so we know it's a real, they're naming people, kind of. They're naming publicly traded companies. Those aren't just randomly people issuing stuff. Now, you'll notice something here. The SEC requires CPA firms auditing publicly traded companies to use the AICPA's auditing standards, but the PCAOB makes their own auditing standards. The PCAOB has actually said that they must use both. So if you are auditing a publicly traded company, not only do you have to follow your own standards, the PCAOB standards, but they say you also have to follow the AICPA standards. And if there's a conflict, the PCAOB's rules trump the trump's probably a bad word. People think they are more powerful than the AICPA's rules. But you legally must follow the PCAOB rules as part of the law. So, for instance, there's some things that the AICPA is more lenient on, which we'll come to in Chapter 3. But the basically you have to take the stricter standards of the PCAOB if you're going to audit publicly traded companies. But they also approve companies for auditing publicly traded companies. They approve CPA firms for auditing publicly traded companies. So if you have a CPA firm, you can't just audit a publicly traded company. You have to go to the SEC and they have to register you to be able to do it. And there's hoops to jump through and all that kind of stuff. So they actually register the companies. If you're not registered, you can't do the audit. So you could have a CPA firm that's perfectly fine, perfectly legal and all that. But if you want to audit publicly traded companies in the United States, you have to get registered with the PCAOB. And they have regulations and that go with it. So here's the kind of thing that is kind of true, is that the SEC and the PCAOB cannot take away your CPA license. They didn't issue it, they're not a state. The federal government cannot take away your CPA license. However, if you're a large CPA firm, you probably make a lot of your money is made off publicly traded companies. So they do have control over saying, look, we can pull your registration. If you don't behave right, we can pull your registration, and then you can't audit publicly traded companies, and basically you'll be out of business. So for large CPA firms, they still have to kind of jump through the hoops of the SEC and the PCAOB because they're getting registered. And if they ever lose that registration, they're out of business. So while they can't take their licenses away, what they can't take away is their business. So very powerful groups here. PCAOB is, and it was created by the Sarbanes-Oxley Act. Okay. Okay. Which of the following organizations can license certified public accountants? Anyone?
C.
Yep. B, and which ones can revoke them? Same. So states issue the license and states can revoke them. These other groups, the AICPA, Securities Exchange Commission, Public Company Oversight Board, they have no control over licensing. They're powerful groups, but they have no control over licensing.
I actually said C on accident. Okay. I get it now.
I heard B, so. There's a great documentary called Perception Deception. I should write it down. But it's about how you perceive things. And we all think that, okay, you see something, you know what it is. You hear something, you know what it is. It's not true at all. Your brain fills in so much of it. So if I'm expecting to hear B and you say C and B sound enough alike, yeah. But it is kind of funny because I've known after I saw that documentary, it's a Nova documentary called Perception Deception. Let me put it up here. It's a good one though, because and actually I'll tell you why I got into it. One thing is the Nova documentary. It's free. It's on YouTube. It's called Perception Deception. And I think I told you guys about the maybe I didn't. Did I tell you guys about memory, about how to remember things? Did I give you guys that handout?
I don't think so.
Okay, maybe I'll pull that up. Maybe I have to break up a little. It's really interesting. I got into it because when I was teaching the CPA review classes at Harvard Morris University, it's like, okay, how do you get all this information, cram it in? How do you remember things? And so I got into this thing about memory, not because I had any particular interest in it other than the CPA exam, but it kind of drew me in. And it's really interesting about how the brain works and how you got to kind of trick it to remember things. You're programmed to forget things, but how do you kind of reprogram a little bit to remember things when you need to for like the CPA exam? Okay, CPA firms. There are local CPA firms, and these will have, say, 1 to 5 partners usually. And they will concentrate on smaller clients. They'll do a lot of accounting, taxes, and usually less auditing. what you'll find when you look into accounting is basically the size of the firm kind of goes to the size of their clients. Smaller firms usually have smaller clients, just because they fill that need, and when you pass the CPA exam, you can become you can have your own CPA firm right immediately, and just be yourself. I mean, there's nothing. There are definitely people that started out that way, and continue that way. They just like it. They like being able to set their hours. They have their clients set up and all that. Okay, regional firms are usually say like 5 to maybe 20 partners. And they have mid-level clients usually. And they'll do accounting, they'll do taxes, and they'll also do some more auditing. And they may be in several states. Illinois, Wisconsin, and Indiana seems to be a natural fit that you can get to. Those 3 states were pretty close together, so a lot of times we'll have firms that will be there. National firms will have offices in most states. Say 20 to maybe like 120 partners. And they'll be in most states. And they'll mostly be doing, they'll still be doing taxes. They do taxes all the way up to the top. They'll be doing auditing and consulting. And they'll have their clients will be national.
Regional?
I'm sorry?
Oh, my bad.
No, sorry. So for instance, I want to talk about this for a second though. National firms. Oops. Yeah, the regional ones will have regional clients. Okay. So going to national and international firms, it's not just that people are snooty and they don't want to use the smaller firms. If you have a company that is all across the United States, you have let's say that you have offices or areas that you do business in 45 states. You pretty much have to have a CPA firm that has offices in most of those states, right? It just go, if there was only 5 people in the office, there's no way you can do an audit like that. It's too big. So that's why you kind of tend to have smaller businesses use smaller CPA firms, and as they get bigger and bigger, they use bigger and bigger CPA firms. And so, the national firms will have large clients that have, trucking companies or whatever that are all over the United States. Those will be national firms because they have to have, pretty much the audit offices and all that they can actually do the audit. And the last one we're going to talk about are the big 4, and those are international ones. So you have international companies, Ford, General Motors, and they're all over the world. Microsoft and all that, you have to have a CPA firm that has offices all over the world, because this is a big audit. You're going to have people in different places on the planet doing parts of the audit. So it isn't just that, oh, these small firms, we don't like them because they're small. It has to do with the ability to do the audits. And coming down here, the big four, they can have 1,000 plus partners, and they audit the biggest companies in the world. Their clients are the biggest companies in the world. And they'll have offices all over the world. And again, if you're an international company, you pretty much have to use one of these four. If you're going with the United States, there's other countries that have their own large CPA firms. And that's another thing about the large CPA firms. A lot of times, they can have other CPA firms around the world that do their audits. Okay. Let's see here. I think I cut off. What's wrong here? 1 second. Hey, I didn't do anything. All right. I'm just going to bunch these up here. Okay, which of the following firm would it be appropriate for a bakery that operates in Illinois and Indiana? So they're operating out of 2 states. What kind of firm would they probably be looking at?
Regional?
Yeah, probably be a regional firm. They're big enough that you might have going to a smaller firm, the local firms. They may not be able to do an audit because they don't have people in Indiana or whatever. But a regional firm would probably be most likely. And you could go to these other ones, and quite honestly, these other ones charge a lot more. So there's also this idea that if an audit, you just need an audit. It may not be worth it to pay more for it. Okay, CPA firm positions. This is one of those things that seems like it's kind of trivial, but it's not, and I'll tell you why. The AICPA, there's 4 different levels in a CPA firm according to the AICPA. Okay, you'll have your associates, sometimes called associate auditors or whatever, associate professional or whatever they are. That's where you come in at. Then they go to the seniors, sometimes called the in charge, and I'll put that on there in a second. But then there's a senior level, then there's manager level, and then there is partners. And we'll talk about how you move up there and all that kind of stuff. But here's the weird thing. The AICPA has different rules for those different groups. They have different rules for associates. They have different rules for senior auditors. They have different rules for managers, and they have different rules for partners. And you say, well, wait a minute, my CPA firm isn't organized like that. We do it differently. The AICPA says everybody must fit into those 4 categories. So you find which category they most fit into. So there is this kind of thing that, the AICPA, when they make the rules, they're aimed at those 4 categories. And even if you're, maybe you have 5 categories, maybe you have 3 categories or whatever it is, they say, okay, well, for everybody in your firm, you got to find one of those 4 categories they fit into. So, while it sounds kind of trivial, it actually is part of the accounting rules. Okay, staff assistants are usually not CPAs. The CPA license is not required. And this is where you start out at. And basically, your work is to complete tasks given by the senior auditors. Senior auditors are sometimes called in-charge auditors. Okay, now the CPA exam does not focus on staff assistants or associates very much. And there's a reason why, because basically everything that you do as an associate is what your senior tells you. So that would be the answer to every question. When you're doing this, what do you do? Ask the senior. What do you do? Ask the senior, whatever the senior says. So they don't really concentrate on these staff assistants, and these are usually not CPAs. So this is, the CPA exam is not going to be focused on those. So when you first start auditing, generally you're not required to be a CPA. They'll hopefully, if you want to move up though, you do need to become a CPA, because at a senior level, you must be a CPA. And these will run the audit. By the way, these are usually pretty well paid. Auditing in general is kind of a higher paid profession. So a lot of times these will be higher paid. I think the staff is, for the big 4, I think the staff assistants are starting out at like 70,000 or something like that. It goes up from there. And seniors, it's not unusual to be in the 100,000. Managers, probably 150, 200,000. Partners could be over $1 million. Okay, so senior auditors, and let's run the see. This is what the CPA exam is directed at. So this is what the CPA exam is mostly focused on, are these senior auditors. And they'll be running the show. And you'll notice something here, it's 2 to 5 years. That's pretty quick. If you think about it, especially if you're a larger company, that you could come in without doing any auditing, And within a couple of years, 2, maybe 3 years, they expect you to be running the audit, and for a big company, IBM or whatever, could be a very, very large company. And again, you only have 2, 3 years experience. They really move you along fast. This is why going to work for a CPA firm is considered it's a very prestigious position in accounting. Is probably the quickest way up the ladder is to go through a CPA firm. And a lot of times, if you have a couple years of CPA firm experience, it's huge. It's huge on your resume. So it's one of those kind of jobs. It's not easy. It's huge, long hours during the busy seasons, the tax seasons, the audit seasons. You're working 7 days a week. But again, once you go through that, if you do leave the CPA firm and go and work, you get a leg up. It might knock 5 years off how long it takes you to move up the ladder to the next positions. So they're kind of the hot shots, but again, they move you very quickly. It's not a easy, hey, come on in and have coffee. It's not like that. It's a very focused and direct kind of move up. But anyway, so seniors are 2 to 5 years. Managers. Managers will oversee probably somewhere between 5 and 15 audits for the partner. And so this is who the senior will contact usually if there's a problem. Okay, partners. Partners are responsible for bringing in clients. And that's basically their job. That's it. Now, and this is true for any partnership. And then people say, how do you make partner? Whether it be in a law firm or wherever. To make partner, you have to bring in clients. You can be a terrific auditor, but if you can't bring in clients, you're not going to be a partner, because that's what partners do. They bring in clients. So partners are almost like really high-end kind of sales jobs. Almost they're very much in getting clients, getting them to getting comfortable with dealing with their executives and all that kind of stuff. A lot of golfing in the United States, anyways. It's a lot of golfing. That's kind of unusual to the United States for whatever reason. It's also some true in Asia, but in the United States, it really is the golfing. I met a new a partner where my sister lived. There was a guy, his wife were across the street. Were like he just became a partner, and they had to take out a loan to pay the entrance fees for these golf clubs that he had to basically become a member of to get clients. So I mean, hundreds of thousands of dollars, but that's what it is. These are they're people that bring bring in money. That's how you make, that's you can partner. Now, in a CPA firm, it's either up or out. And so if you cannot, you'll notice when you look at this thing, it says staff assistant associates 0 to 2 years. It doesn't say 0 to 20 years, 0 to 2 years. And if they can't move you up to a senior, you're going to be out. So if you don't pass the CPA exam in the 2 years you have there, or if you don't, if they don't think they can make you a senior, you're going to be out. If you're a senior, notice it doesn't say 2 to 25 years, it says 2 to 5 years. If they can't make you into a manager, you're going to be out. If you're a manager, they can't make you into a partner, you're out. And this may sound very cold, but this is the way all partnerships work. Partnerships have to have partners. And something like 1 in 100 people who go into CPA firms become partners. It's a low percentage if you don't actually become partners. They can't have those positions plugged up with people that can't move up the firm. They can't have people, you can imagine that if you have people who are good workers, show up every day, do all the work, do a really good job, but if they cannot be moved up, you can't have them sitting in that place that might be taken by a future partner, right? Eventually, the CPA firm will just die if they don't keep those positions open. That okay, they're going to last 2 years, and if they don't move you up, you're being moved out. Being moved out though isn't a bad thing, because you have if you get a couple years of experience in a CPA firm, when they do move you out, you got a huge leg up on the competition, because you have a couple years of audit, of CPA firm experience, and you take that with you. And not only that, a lot of times the CPA firms will try to get you in with their clients. So if you're working for Deloitte, and let's say that they do audit of IBM, Deloitte will say, look, we got this young person that, really good work. We just don't have a place for him or her. To IBM, they'll say, do you have a place? And IBM, knowing that you've been through the baptism of fire being in a CPA firm, will say, yeah, we'll hire them and send them on over. So a lot of times being moved out is not a bad thing. A lot of times you get a bump up in pay, and you work a lot fewer hours. So up or out might sound really terrible, but actually it's not so bad. And sometimes I would think that you'd almost be better off getting moved out. Being in a CPA firm doesn't get any easier as you go up. All the way up to the partner level, they're working, 60, 70 hours a week often. So it doesn't let up. And, so sometimes getting moved out is not, while it sounds terrible, it's not such a bad thing. But that's the way CPA firms work.
Professor?
Yeah.
What's like the percentage of like staff 1 and staff 2 that like get moved up to seniors and managers
Probably,
at Big Fours?
yeah, probably something like 1 in 5 maybe get moved up. I mean, most people, and quite honestly, the work is pretty demanding. And so a lot of times when people get, they say, hey, we got you this job at, wherever, IBM. A lot of times you say, woohoo, I get to sleep now. But probably like something like 1 in 5 maybe make it up to senior. And maybe out of those, probably something like, probably like another 1 in 5 make it up to manager. When seniors come out, they do very, very well usually when they come out. When you're a senior, you have that you've run an audit, and so a lot of times companies will like to have that, because not only do you know what an auditor is expected, the audit will go smooth, but you know exactly what they're doing, and that it really is a kind of a real leg up if you become a senior. And managers a lot of times will go into very high positions in companies. And managers probably like 1 in 4 or so. Maybe it's less than that. Maybe like or I mean more than that, maybe like 1 in 3 make it to partner. But the problem is a lot of times these people like that are managers are very good at doing audits. You know, they're very good at running audits. They're not really the kind of extrovert salespeople type. You know, and some people just develop that. I've seen people that were kind of to themselves, and then all of a sudden become just out of necessity or whatever it is. That they step up and they become something different. That when they're with a client, they're completely different than when they are at home talking with their dog or whatever. So but it's a and that's true with all partnerships. Is bringing in the clients is really what moves them up. But probably like say 1 in 5, and then maybe like another 1 in 5 of the seniors make manager, and then probably something like 1 in 100, somewhere in there, makes the makes it all the way up to partner. And partners, well, so, I'm
So
sorry.
if you can make it to manager, you have you can have a good 10 years with the company.
Probably, yeah, at least, yeah, yeah, and like say managers, they usually go very high in consulting. They do very high. They do usually pretty well if they do leave the firm. They usually do very well because they're people that are very sharp. They know how to run multiple things, and people like that they're not overwhelmed by anything. They'll be running 5 audits simultaneously through different seniors, out doing audits and stuff. So it's not that unusual for them. And
What position were you at IBM?
oh no, I was actually an internal auditor. I was at first I was at Navistar, then I was at U.S. Steel. Navistar makes trucks, and I was an internal auditor. I used to do a lot of work with the external auditors. So I was actually an internal auditor. I didn't work in a CPA firm. I actually had an offer to work in a CPA firm, and I often wondered if I should have taken it. I took the company one for probably the stupidest reason, is that it paid more. But it probably was, and, like, I don't know. I think of the CPA firms. This is years ago. That they were offering like 30,000, maybe 31,000, and I got a job at 34,000, and I thought that was the coolest thing, and it didn't work out bad though. I liked it, and yeah. So I was an internal auditor. I worked for a company. So IBM will have auditors inside the company, and those auditors will be internal auditors that will work for IBM. And quite honestly, those are really good jobs. These internal auditors, like for instance, my internal audit job when I was at Navistar, right out of school, graduated, went to work for them as internal auditors. And I remember like the first, I think it was the second week actually. I was in a meeting that the president of the company was there. There's people that have never had a meeting. I've worked the place for 40 years and never had a meeting with the president was there. But it was literally us, a few of us auditors, and the president of the company. You get exposed to people very high up in the company immediately if you're on internal auditing, and they'll know your name. They'll say, hey, Mark. It's like, I've been here like 4 months, and the controller knows my name. The people that work here for 35 years, the controller doesn't know. So the internal auditors they're very good positions to be in. You will learn so much. I learned so much about companies as an internal auditor. But I used to also work with the external auditors, and Deloitte & Touche was the auditors for Navistar. They were also the auditors for U.S. Steel. There were 2 different groups that I worked with, 2 different partners that were running those audits, but I worked with the external auditors doing those things. It's different kind of auditing, but yeah, I was never in a CPA firm. But they're good. They're good to get into though, and if you can't, I'll tell you one more thing, and maybe we'll take a break then. CPA firms, internships are big with them. So if you can get into an internship, and I'll talk to Dr. Knudsen about getting information about how to get those internships. And we do have people that have gotten internships and gone up the ladder in those. Internships are their big thing. If you get an internship with a CPA firm, they'll bring you in and they'll, you go through the internship, and usually like 95% of the people that they bring in as interns, they get offered positions as associates to come in. So the internship is that's kind of the test, and you know, if you get those internship positions, be there all the time, be on time, work extra hours, hang around, see if anyone needs any help, be as good as you can be in that internship, because that's what will land you the job. And most of I would say probably 95% of the people they get in come through those internships. So it's a huge percentage. And the CPA firms, they don't change. They're going to have their ways of bringing people in. And, you say, well, I didn't do the internship. Can I go there? It's going to be a really hard way to get in if you don't do the internship. I'm not saying it's impossible, but if you don't do an internship with CPA firms, it's a little trickier to get in. Any questions on that? Yeah, I'll see if I can get out some more information to you guys on that. CPA firms aren't the only thing to go into. We talk about it a lot because the CPA exam is based on those, and because it's kind of the hot shot positions. But I didn't do it. I was an internal auditor for Navistar and then U.S. Steel. So there are other, there are definitely other paths, in accounting and auditing to go through. But we kind of focus on those because the CPA exam is based on that. And the CPA exam, passing the CPA exam is sort of like the stamp of approval. And even if you don't go into public accounting, I would encourage you to think about taking that CPA exam. It's difficult. People pass it every day though. And it really does move you up the ladder too. That CPA behind your name is a stamp of approval, and anyone who sees that will say, "Oh, this person knows what they're doing." And you got a stack of resumes this high, and if 3 of them are CPAs, well, guess what? Those are probably the 3 that are going to get called in first. They may not get the job, but they're probably going to be the ones that are going to get called in first. Any questions on that? So the CPA, even if you're not going to be a certified public accountant, passing the CPA exam is not a bad idea. Okay. All right, well, tell you what, let's take a break here and all right, let's see, so you'll be back at, what time is it? 5:57, so let's say 7:07? Okay. And we already did this, so we don't have much more to go on here. Okay. Okay, tell you what, we're going to finish up these are actually pretty quick. Probably should have done this before we went to break. Then we'll go into the multiple choice questions. What am I here? Okay. So basically, we're looking at what these groups are. So AICPA. Who do they make rules for? Anyone? You can put it in chat if you want.
Yours.
Actually, it's for both. They make for non-issuers. So if it's a privately held company, they'll make rules for you. But also publicly traded companies, they'll also make the rules for those for audit firms that are auditing those. Is it a government agency?
No.
Nope. They have no real power of their own. Can they issue or revoke a CPA license? Nope. Only states can do that. Registered CPA firms? Nope. Creates the CPA exam? Yes. And all the states use it. They don't have to, but they do. So it's not a government agency. They can't issue a license. But they do make the CPA exam, and they do make rules for non-issuers and issuers. Okay. State laws. Makes laws for, again, this is for both. Just because they are an issuers, just because they must follow federal laws doesn't mean they don't have to follow state laws. Okay, are states government agencies? Yes. Issue revoke CPA licenses? Yes. Registers CPA firm users? No. For issuers, I should say. Creates a CPA exam? No. They use a CPA exam, but only the one made by the ACCT330. They don't make it themselves. Okay. Public Company Oversight Board, PCAOB. They make laws for issuers. You must be publicly traded, or else they are not going to. Their laws don't apply if you're not publicly traded. So Joe's hot dog stand doesn't have to do anything the PCAOB says. Government agency? Yes. Issue revoke CPA licenses? No. Registers CPA firms? Yes. Create CPA exam? No. Okay. A couple things here, then we'll be done. What type of misstatements do auditors look for? Only material misstatements. So They have to be material. We don't look for immaterial misstatements. We don't look for little dollar amounts. We don't care about those. Only for large enough that it's going to make a difference. And for large companies, material can be very large, tens of millions. Okay, characteristic of an error. You say, well, how, was it a mistake or was it fraud? The characteristic of an error is that it's unintentional. Oops, I put in the wrong amount. And what do you think the characteristic of a fraud is?
Is it intentional?
Yep, intentional. So an error is unintentional, fraud is intentional. And fraud, by the way, is a little bit more serious for auditors because a lot of times, if someone makes an error, it'll get caught a lot of times. It's the intentional ones that are more difficult because there's usually someone trying to cover it up. Cover up the misstatement. If it's truly unintentional, I get a invoice for a $6 stapler and I enter it as $6 million. Okay, someone's going to catch that. Someone's going to say, "Hey, how come my budget's getting hit for $6 million? The bill for the year is only 200,000. How did that happen?" So a lot of times the unintentional, an error is caught, whereas if it's intentional, someone specifically goes out of their way to make a misstatement, that it will it's harder to catch. Okay, type 1 fraud. This is I'll tell you the term for it, and then I'll tell you what it really is. Misappropriation of assets. What it really is employee theft. So type 1 fraud is employee theft. They call it misappropriation of assets. Quite honestly, though, there is a difference between fraud and theft. This is the AICPA's term, though. Is employee theft basically is type 1 fraud. You can't have an employee that just steals something and that's not fraud. If they steal something and try to cover it up, then it is. So there's there has to be some kind of a misrepresentation for it to be fraud. Whereas you could just have someone, working at Walmart and they take a bag of M&Ms and stick it in their pocket. That's just theft. There is no cooking the books trying to cover it up or anything. So it is possible that it is even type 1 fraud. It is possible that it's just plain theft and not necessarily fraud, but they use it as they use that term for all employee theft. Type 2 fraud is fraudulent financial statements. What they call cooking the books. Which one of these two do you think the auditors are more interested in? Oops. Employees stealing or fraudulent financial statements?
Fraudulent financial statements.
Yep. This is what the audit is about. It's part of the financial statements. And if someone's stealing, well, we don't encourage that, obviously. It is, unless it's a very large amount, it becomes material, we're not going to worry about it. So this is really the one that we kind of focus on as auditors. Okay, illegal acts. So if your client is doing an illegal act, those that have direct effect are more important. So a direct effect would be something like tax evasion. Because your tax expense will be understated. So there's a direct impact on it, on the financial statements. And so, when we look at, first of all, it must be material anyways, but things that have a direct impact are those that are more along our lines. Other laws, for instance, EPA violations, Environmental Protection Agency violations. It's true that they might fine them, and that would be part of the financial statements, but they could also just maybe tell them to knock it off or whatever. So when we look at illegal acts, we're really looking at those things that have a direct effect. These are the ones we're more interested in. Okay, responsibility for detecting illegal acts. Only material illegal acts need to be included in the audit. So you're only looking for those things that are material. Again, this materiality keeps coming up and coming up. The financial statements, you only sign off on it for material, free of material misstatements. Not that there aren't any other ones. So you're only looking for material things that the financial statements if they're not material. For example, let's say that the chief financial officer double parks in the alley every day. It's illegal. Is that going to show up in the audit? Probably not. It's probably not material, and well, it is a jerk thing to do. So you're only looking for those things that are going to have an impact on the financial statements that is material. Okay. Let me see. Okay, this is the last thing on this. Very good. Hey, we may even finish it. I think we will. Responsibility for reporting evidence on illegal acts. And the board of directors. Our audit committee. All right, let me clean this up a little. Illegal acts should be reported to the board of management and the board of directors or the audit committee. So if you do come across illegal acts, and sometimes the board of directors or the audit committee or even management will say, look, I know you're only supposed to report on material things, but if you find anything, let us know about it. And you should. It doesn't matter whether someone's stealing $200 from whatever. Okay, that's not material, but again, as being a citizen and being a professional, it's your job to let them know that this is going on. So illegal acts are, a lot of times you report all of them that you find, but you're basically supposed to tell them things that are significant or material. But again, oftentimes as a courtesy, you'll tell them about all of them, and these go to upper management and they go to the board of directors. It becomes a little bit more difficult if it is management, upper management, that's doing these illegal acts, because then you have a problem. You have to go to the board of directors, and then you basically get lawyers a lot of times to come look at to tell you what your options are. And I think in the next chapter we talk about what happens if management doesn't do anything. You tell them about an illegal act, they don't do anything. There are ways to report it that we'll talk about in the next chapter. But basically, you don't, do you do the investigation yourself? No, it's not up to you to investigate these. You find somebody's embezzling $10,000 a year or whatever. It's not your job as an external auditor to investigate that. You got to look at the financial statements, trade material misstatement. That's what they hired you to. You're not going to get sidetracked on looking at some embezzlement scheme or something like that. So you give it to management, and management is, it's their company, it's their responsibility. They'll deal with it. Okay. Hopefully you guys in your email got the multiple choice questions. Did anyone did not get them? That's kind of a boring screen to share. Okay, here we go. Is everyone so everyone got it, I'm assuming? Okay, let me go ahead and start a poll, and I think there's 10 of them here. Yeah, these are 10, and most of these are actual CPA exam questions. So go ahead and go through these and give it your best shot. If you're not sure about it, put your best guess in. And let me see here. So multiple choice questions. If you get 5 correct, if the group gets 5 correct, oops, that's not 5. I will add 2 onto the exam. If you get 7 correct, plus 3 on the exam. If you get 9 correct, plus 4. And if you get all 10 correct, okay, so go ahead and you'll go through and answer these, put it in the poll, and we'll close up the poll here in a little bit. And yeah. So again, is there anyone that did not get the multiple choice questions? Okay. I'll put this up later. Sorry. Are there still people working on the multiple choice? If you are, that's fine. And you can also put it to me in the chat. Okay. Yeah, so if you finish up, and then I think you have to put something in for all 10 of them, but then submit it, and it'll go in the group. And don't worry about, if you make a mistake or whatever, because the results that are released, they don't show your names. I can see who participated in it, but it doesn't show your names or anything like that. So, okay, looks like we're done. Yay, okay. So we'll share the results and we'll go through these. These are hard. There's a couple of there's one of these I'm definitely going to throw out that if you get it wrong, we'll count it. Okay, first one. Who is responsible? Management of the company. Move something here. So, yay. Financial statement audits. They can do those other audits, but their bread and butter are these financial statement audits. That's what the license is for. Which organization grants the right? State Board of Accountancy. Yeah. Good, you guys got this one. This is a tough one. I'll tell you why these other ones are wrong. First of all, you only look from misstatements that are material for this one. So if they just say a misstatement, you're actually not just looking for a misstatement. And we very rarely say the word corrected in auditing. So this would be material. Poorly designed internal controls may not result in financial statements being misstated. One of the, a company may have poor internal controls, but their financial statements may be fine. Okay, management fraud exists, is more likely to be detected by independent auditors. Well, further, they about fraud, and if it's not material, it wouldn't be. Again, materiality comes into play here. Not only that, most fraud is not caught by external auditors. Most fraud is caught by employees. External auditors are external auditors are only there for 3 or 4 weeks out of the year. It's more likely that someone who's there every day is going to say, "Oh, wait a minute, there's someone committing a fraud here," and report it. So usually, the vast majority of fraud is caught by employees, not by external auditors, and even internal auditors. I've caught a couple people doing fraud, but generally the employees are the ones that catch it. And even for internal auditing, a lot of times we'll get tips that there's a fraud here, and then investigate it, and that's how you come across it. So employees are much more likely to catch a fraud than the auditors, external auditors, or even internal auditors. Okay, operational audit. Yep. Yep. Good. This is a good one. Okay, some of these other ones that look tempting. We never look for all legalities. We only look for material. So one of the things you're taking CPA exam questions, whenever they say all or absolute, correct, those are kind of red flags. We generally don't talk in those terms when we're talking about auditing. So we don't look for all fraud. We don't look for all misstatements. Only those things that are material. We don't give absolute assurance. We give reasonable assurance. And I don't know what that one is. Truth in lending laws. That's something for banking, I guess. Okay. Yep, compliance audit. Very good. Well, you're 8 for 8 so far. Yes. C is it. Any disputes have been settled to satisfaction. And the disclosures up here are part of the footnotes are part of the disclosures. And actually part of GAP are the disclosures. So the footnotes are actually part of the financial statements. So this would be, these are all, the footnotes are also are required. Yep. And again, we do not investigate it ourselves. We might maybe do it separately or something. They might contact us later, but for the audit itself, we just give it to the highest level people in the organization, and they should take care of it. Very good. Okay, that is. We download these. What is this? This is. And +5. I don't think I put +5. I'll say 5 points. Okay. Well, it's a blank screen, so I guess we can get rid of this. All right. So that's it for the class. So here's what's going to happen next. We'll do the. Well, I'll put the answers for the classified financial sample. I put the solutions up for that for 3, 4, and 5. So I'm going to send out I should say email. It will be due on a week from Friday, the 22nd. And I'll email this out after class. You should get it by like 10 o'clock at least. You should be out there. Hopefully sooner than that. And then I'll put the classical sampling up now. And if you have any questions on it. If you don't have any questions on classical sampling, then we're done. But I'll go ahead and put the classical sampling up so you can kind of see the solutions to it. Number 3 was interesting in that you guys probably came up with this, that it is. 3 was kind of, this is number 3. Oops. 3 is kind of interesting because mean per unit was overstated and ratio and difference estimation were understated. So number 3 was a little bit tricky. Yeah, you made a screenshot of that just to check your answers. And let's go to number 4. Number 4 is probably more similar to what you'd see on the CPA exam. Oops, I got cut off here. Try that again. Problems 4 and 5 came right off the CPA exam. The numbers are changed, but you get a screenshot of that one. And then lastly, oh wait, I got, sorry, I cut off E. A screenshot, this is number 4. Okay, and lastly, whoa. Oh. This is what the suggested correction would be. If you're going to do it, if they ask you for what the correcting journal entry would look like, would you think that? Be taking off the accounts receivable. Oh no, I'm sorry. What is this? Well, it's understated. Oh, adding accounts receivable on the books and revenue. And if they don't have the accounts receivable per client, they would have to put that in as what they would call kind of a clearing account until they find out who it is. Any question on that? Okay, so that's those. Okay, so I will, after class here, I'll send out the exam. The exam is not due it's due a week from this Friday, so you got, whatever, it's 10 days. It's due on the 22nd. Yeah, you got 10 days to do it, so plenty of time. It's mostly essay questions, so a few multiple choice questions, but which are similar to what we just had. But anyway, I'll send that out. I should have it out by 10 o'clock, maybe earlier than that. But you'll get it in your email. It will not be in Blackboard, but you will submit it in Blackboard. Any questions on that? No? Had enough? I think I have. All right, well, I will see you guys in a week's time, and I will have a place for the sampling to get submitted, and then also the classical sampling to be submitted, and then also for the chapter 1 and 2 exam to be submitted, and the handout. So the handout could be submitted too. So we have 3 things that we can turn in, and they are these things. Nope, not that. Nope, not that. So you can turn in this. You can turn in this classical sampling and the 1 and 2 exam. So those 3 things in yellow can all be turned in. Well, this one I haven't sent you yet, but chapter 1 and 2 handout and classical sampling, those can be turned in immediately. And then the 1 and 2 exam after I send it out, and they'll be due on the 22nd. Okay, I will see you guys in a week's time. Everybody, see you guys.
Have a good one.
Thank you.
Thanks, Professor.
Thank you, sir.
Thank you.